One thing I've learned after nearly 30 years in property is that behind every property transaction, there's a story, a big decision, and often a lot more emotion and complexity than people expect. This podcast is all about giving you access to the people, insights, and strategies behind smart property decisions so you can make better moves, whether you're buying your first home, investing, selling, downsizing, or planning your next step.
Welcome back to the Melbourne Property Brief with Warwick Brookes. With the end of financial year approaching, today we're diving into the financial and tax side of property ownership, because while many people focus heavily on buying property, there is often far less understanding around how ownership structures, tax strategy, cash flow, and planning decisions can significantly impact long-term outcomes. There's also been enormous discussion recently around negative gearing, capital gains tax, SMSFs, and property investment structures. So I think this is going to be a really practical and timely conversation. I'm joined today by Christie Semmens from Semmens Partners Accountants. Christie works closely with property owners, investors, and business owners across tax planning, investment structures, compliance, and long-term financial strategy. And with the end of financial year approaching, I think this conversation is incredibly timely. There is so much discussion right now around negative gearing, capital gains tax, SMSFs, land tax, depreciation, and investor strategy. But for many people, it can feel overwhelming trying to understand what actually matters, what applies to their own situation. One thing I really like about Christie's approach is the ability to take what can often feel very technical or complicated financial conversations and explain them in a much more practical and understandable way. Because the reality is, some of the biggest property mistakes people make aren't always about the property itself. Sometimes they come from structure, planning, or financial decisions sitting behind it. Christie, thank you so much for joining.
Thank you for having me.
Christie, before we dive into the property side of things, can you tell us a bit about your role and the types of clients you typically work with?
So I'm an accountant and tax agent. We have quite a varied client base, ranging from individuals to business owners operating through companies and trusts, or other companies and trusts that investments are held in. And we also deal with SMSF clients as well.
So the end of financial year is coming up quickly. And many people tend to leave things until the last minute.
Yep. What
are some of the things property owners and investors should be thinking about now rather than in another month's time?
Look, there's a few things to be thinking about. So one thing that a few clients tend to miss is getting maybe a depreciation schedule in place before 30 June. That's one of the super important. You can also start thinking about, like, should I be doing some repairs and maintenance on a property like close to the end of the financial year? But obviously, if there are a few bits and pieces that need to be done, maybe it's a good time to do it now before 30 June rather than pushing it into the next financial year. And then the other thing to consider is the loan structure as well. Is it worthwhile doing a property refinance? Not that that's necessarily going to help before end of 30 June. It might help with a lower interest rate, just depends. But yeah, that's some of the things that I'd be looking at. And just make sure you've got all your records in place. So when it comes to tax time, that you're not scrambling to get all your receipts. And, we often have to ask clients, have you got the receipt for this? Have you got the receipt for that? So record keeping is really important, probably more so now as well with the ATO conducting more audits.
Yeah, and I think like speaking to an accountant before you even start the process of wanting to sell.
Oh my God, absolutely.
Important, because a lot of mistakes that I see people make is that they end up selling a property in June.
Mm-hmm.
And
they think it doesn't occur to the next financial year, the capital gain.
They don't understand that their capital gain is now due as of the 1st of July.
Yeah.
And if they had waited another month, they would have an extra year to pay that capital gain.
Yep. A lot of people think it's on settlement date, not on contract date. There is a quirk in the law that says that if the property settlement doesn't go through, you can go and amend the return. So let's say, for example, you sign the contract on the 1st of June and settlement's in the next financial year, but for whatever reason, it doesn't go through. You can not have to declare the capital gain, obviously. But yeah, that's a big one. A lot of people think but I sold it after the end of the financial year. I don't have to declare anything. And then we have no time to do strategies like, I have to be careful what I say here, but like superannuation to offset some of the capital gain,
Yeah, and I also find it amazing that so many people sell a property and they don't even know what the capital gain is going to be.
Yeah. Look, most of our clients are pretty good. Like I had one reach out to me earlier towards the end of last year, actually, knowing that he was going to have a capital gain, and we did some like strategy work on that, which was fantastic, like really good. So it's really important to just consult with your tax advisor, to say, this is what I'm thinking of doing. Can we do some pre-work? I know it might cost a little bit of money to get the tax advisor involved, but it could save you thousands in the long run, So it's always definitely beneficial to consult, whether it's purchasing property, selling the property. Yeah.
The other thing that I have come up that a lot of people don't speak to the accountant about or even understand is the capital base of a property. So they buy a property off the plan, they might borrow 80%, they depreciate a lot of it, they sell it for a loss, but they have a capital gain because
you have to add back.
their capital base has changed.
Yeah.
And people, they don't understand that depreciation is a tax offset.
It's timing kind of,
And
benefit.
if you don't speak to your accountant, then it can really have
absolutely. Yep. So you always have to add back the capital works deductions that you've been able to claim. So, whilst they're a great, what we call a non-cash benefit, because you're not having to physically hand out 10 grand, you do have to add them back for capital gains tax purposes. Yeah. No one likes to make a loss on a property. So that's definitely something, people need to consider as well.
So there's been enormous discussion following the recent budget around negative gearing and capital gains tax. What should the investors actually understand about these conversations beyond the headlines? And while we're in this kind of limbo land, and before things kind of get through?
Yeah, it's a really difficult one because as an advisor, it's hard to know what to recommend to clients at the moment. I was having this discussion with a tax specialist the other day because you don't want to tell a client to sell an investment property now, and if the rules don't actually change, they might say, well, why the hell did I do that for? Or somebody might be looking at buying an investment property and they go, well, I'm not going to get the benefits of the negative gearing, so I won't go and do it. But that's not necessarily the right strategy. And unfortunately, until we've got some firmer rules in place, we're just in a little bit of limbo land at the moment. So I think if you are looking at buying a property, for example, it's got to be for the right reasons. Do you know what I mean? Like it's not just about, well, it's going to give me a negative gearing tax deduction.
It needs fundamentals.
That's right. As long as the fundamentals behind it are right. And then in terms of, structure options, etc., that's also something to consider. I mean, I had a client call me the other day, for example, and they just actually wanted to know what the entity name was to buy this asset in. And then once we delved more into it, I'm like, so what is it exactly that you're buying? Like they just wanted the entity details from me. And I said, but what is it that you're buying? Are you expecting capital growth? In the end, it was that they were going to buy something in their trading business. And I said, no, let's keep it out of the trading business because, it's potentially got asset protection issues. And so these are the conversations that you need to have, and I said also with potential legislative changes as well, it's probably better to buy it in the company. So
I've seen a bit of a flip online for the property Spruiker type people.
Are they going for the SMS?
They're all going, now buy it in a company name now or SMSF. And it amazes me how these property companies who actually have no qualification promoting you to buy. One I saw was buy in a company, divert the money to another company, and then go to your trust. And I'm like, okay, that's a fairly complicated structure.
Yeah.
And you're kind of mum and dad type investor.
They won't understand.
It's just, it's not feasible. And people go online, and I've had some people reach out to me and say, should we restructure to do these ways? You really need to speak to someone about this because it's not as simple as they say.
No, that's right. The property Spruikers buying are suggesting to buy in an SMSF is particularly an issue, especially where, somebody might have like $90,000 in their SMSF. And it's like the numbers don't stack up.
And they're telling people to buy properties in an SMF that aren't going to go and grow in value.
Yeah.
Which, if you buy a property in super and it doesn't grow in value, it's been an absolute waste.
Absolutely. That's right.
Super's only good if your property grows in value.
Exactly. And also, because the costs of running that self-managed super fund can be, especially if you're borrowing as well, it's a lot. You'd be much better off to leave it in an industry-based fund at directly invest through an REIT or something like that. I won't touch those personally. I'll just say to clients, it's just not something that we would kind of recommend, probably doing myself out of some business. But
we always have quite a few people come to us and say they want to buy in super.
Yeah.
And I say, okay, well, this is the asset you really should be buying.
Yeah.
And they say, oh, it doesn't suit us because I don't want it to be negative, I want positively geared.
Mm-hmm.
If you're buying positively geared in super, then you can't get both. You can't get positive and good capital. Right?
Yeah.
So
It's one or the other.
I wouldn't be doing this. I wouldn't be putting everything, or your whole life savings.
No, that's right. Yeah. Clients have to remember that you need to keep a buffer there. And obviously, for life circumstances, like if there's divorce or something, then you're forced to sell the property. If one partner passes away, there can be issues there as well. So you just got to remember, clients have to remember it's a liquid asset. And I know lots of Aussies like property, but it's not necessarily the right, strategy.
Do you think that the potential changes to negative gearing and capital gains tax will have an impact on investor behaviour?
Yeah, I think it will. Look, it will change the equation a little bit because, knowing that you can't get the 50% discount, that is going to be limited to a base of 30%. Question is, what then do you invest in? But yeah.
They're making it pretty hard to invest these days.
Yeah.
Essentially, realistically, super's your only
Pretty much.
really your smartest way.
Absolutely. Yeah, I think there will be a lot more funds that will go into the super area for sure. It'll be interesting to see what happens because even if people do sell their properties, I mean, you'd know better than I would. I mean, a lot of these properties are worth a lot of money. So what young person has got kind of the capability to be able to buy an expensive property?
Yeah. Right.
Not many. It's just out of reach for a lot of people. So I don't know. I'm not sure what that means for the rental market, etc. If investors are selling.
Well, the big problem you have now is that investors who bought investment grade property can no longer sell to investors.
No, that's right.
So you're either selling them at a good discount to a homeowner who wants a substandard property, or you're stuck with it forever.
That's right. And the one that really got us was the pre-CGT, the removal of the pre-CGT.
That was a big one.
That's huge.
I think they snuck that one through.
Yeah, I know a number of clients that are holding onto pre-CGT assets that we're going to have to seriously have a good think about what to do.
I think a lot of those people.
Yeah, I think you have no choice.
Yeah.
Yeah.
Because you're just going to get caught
Absolutely.
in very expensive tax loop.
Yeah. Yep. So it'll be interesting to see what happens in the market. Obviously, these changes aren't proposed to come until the 1st of July 2027, but we just have to wait and see if it gets through the Senate. And I see.
It's going to be interesting.
Yeah, it'll be interesting. More work for us, I'd say.
So just having a quick chat about structures, and a lot of people are confused about, property ownership structures.
Mm-hmm.
How do people decide when they're buying in personal names? Obviously, when you're buying personal names, you can buy in various different ways in personal names. Yep. People buy in trusts, they buy in companies.
Mm-hmm.
How do you kind of start that process with people?
It really depends on the client's circumstances. So, you might have one high income earning spouse and a non-working spouse, for example. So you might potentially looking at buying it in individual names with the high income earning spouse owning like 99.99% of the property and the other spouse owning 1%. Or it depends, there might be asset protection issues that you want to have a look at for them as well. So you might go, look, maybe we buy it in a trust, thinking of the legislation is as it is at the moment, or a company structure. I mean, testamentary trusts were one that people used to look at as well, but they're potentially under fire as well. That's right. So, or, as I said, going back to the SMSF, someone looking for retirement, it depends how much money they've got in their super fund, but it may be an option to buy a property in the SMSF. A good one in an SMSF is commercial property.
Your premise.
Correct, yeah. So if you've got what they call business real property, that's a great one, especially if you're running a business. You can pay the rent from the business across to the SMSF. And if you've got clients in that sweet spot of about 55 and older, you're getting close to retirement age, you can put it into pension phase. Like there's some great stuff that you can do in an SMSF, but you have to have a fairly large sum of money to make it worth your while.
Yeah, most of the clients that with SMSF and that type, they're SMSF
Yeah.
going on.
Yeah.
The other thing that I'd like to get your opinion on is the old barbecue conversations.
Mm-hmm.
How many people kind of getting kind of that
Pub talk.
the pub talk
Yep.
and coming to you with a great idea
Yep.
and having to kind of talk.
Yeah, we've had it occasionally. It's not super, it's not like on a regular basis. We're not getting weekly, hey, I was talking to Joe Blow and they said this. But we have had it in the past, and you just kind of have to go, well, what works for one person doesn't necessarily work for you. So it completely depends on what your income tax bracket is, your family circumstances, what your long-term goals are as well. And, you also have to explain to clients that setting up a structure like a trust or a company comes with additional accounting costs, or if you've got an SMSF, it also needs to be audited. So sometimes people go, oh, okay, I didn't realise that. So it's not what works for you potentially doesn't work for my circumstances. So you just got to kind of educate them, I suppose, a little bit on what the benefits are and what the risks are as well, or the downside.
Yeah, I think real estate is probably one of the pub chats, and people getting advice on where to buy, what to buy.
Yeah, you'd probably see that more than, we would, but like on areas to buy. But yeah, we definitely have clients that will come to us and say, such and such did this, and it's like, well, let's go through it first. So yeah.
So this is flipping back to investments a second, and the infamous land tax, especially in Victoria.
Yep.
And the increases when they reduced it down to $50,000. How many of your clients are just kind of surprised by the land tax costs and were pretty annoyed by them?
A lot. Yeah. So we have had quite a few sell of late or in the last 2 to 3 years because they just said we cannot increase the rent enough to cover the outgoings. So yeah, people are pretty annoyed about the increases in the land tax, and it's just a huge imposition to a lot of them. So yeah, as I said, they've just decided to sell.
It has taken a lot of properties out of the rental market from our perspective.
Yeah.
I'm talking to a lot of real estate agencies since these kind of came in. Their rent rolls have lost about, they're saying 15 to 20%.
Okay, that's quite a lot. Yeah.
That's a lot of angry
Yeah.
say I've had enough.
Absolutely.
I'm getting out.
Yeah. Look, I think when we're in COVID, and maybe this is a bit contentious, and the $20,000 payments were being handed out to businesses, there was a lot of payments going through to people that probably didn't deserve them or need them or were legitimately required to get them. And so now we're kind of paying the price for that because they have to recoup it somehow.
Yeah. So let's go on to tax depreciation schedule.
Uh-huh.
How important are they?
Yeah, they're really important to get a tax depreciation schedule. A lot of clients don't know about a tax depreciation schedule at all. So it's something that if a client does buy a property, we would recommend that they get a quantity surveyor to come and have a look at the property. The great thing is usually most quantity surveyors say that their fee will be covered in the first year of the tax depreciation schedule. Their fee is also tax deductible as well. But yeah, it's as kind of intimated earlier on. So it's a deduction that you get that you don't have to physically outlay cash for. So they'll come and assess the property and they'll go, look, we think we can depreciate the building at X amount. And so you'll get like maybe a 10 grand deduction on top of your other costs that you've incurred. But yeah, really important to get a tax depreciation schedule.
And can you just explain the difference between tax deductions and cash flow?
Okay.
I think a lot of investors get that.
Yep. So a tax deduction reduces your taxable income. So if you're on, say, a marginal tax rate of like 37%, not including Medicare levy, and you spend 10 grand on a repair, right? So you'll be able to get a tax deduction of $3,700. But the difference from a cash flow perspective is that you've had to outlay $10,000 in cash. So that's really the difference between the two. You're still out of pocket, basically.
From a financial perspective, how should people think about interest only versus
We've seen some real changes in that over the last 10 years. Like it was always get an interest-only loan. So an interest-only loan means that you're not repaying any of the principal at all. It can help if you've got like cash flow kind of issues with the property. So you're just paying the interest, whereas a principal and interest loan is where you're actually paying part of the principal down as well as some of the interest as well. But, you always want to make sure that you're getting good capital growth on the property.
Yeah. I mean, you don't want to go interest only on a property that's not going to go up.
Exactly. That's right. Because then you're left with, if you're on interest only, you're left with the same debt that you started off with. So,
Yeah, I see a lot of people going the interest only past, but putting some capital in it is for saving.
absolutely. Yeah, that's right. Yeah, it was super popular maybe 10 years ago. We had a lot of clients doing the interest only. Not as many do that now. Most of them work on P&I and build a bit of equity into the property if they can kind of, with their cash flow needs, fund it properly.
Yeah. So I thought we would kind of finish up with a quick fire what if segment.
Yep.
Because these are questions people seem to ask all the time.
Mm-hmm.
What happens tax-wise if I move out of my home and turn it into investment property?
If that's the case, you can generally continue to treat that property as your main residence for a period of up to 6 years while it's rented. So it's called the 6-year absence rule. Now, you can't have two main residences, though, at the same time. So if you move out of your home, rent it out and buy another home, you can't say, well, I want my new home and the old one to be exempt from CGT. You have to make a choice.
Yeah.
So, but yeah, you just need to make sure also that if you rent it for more than 6 years, that you actually get a market valuation of the time you move it out as well.
Yeah.
Move out. So
Is there a time frame before you can just get out and rent it?
no, you just have to show, like have good records that you've actually had like services like water connected, electricity connected, and I think as long as you can substantiate with the ATO, if they ever came back to you and say, well, this is dodgy, you can say, look, this is what happened. Due to circumstances, we had to move out of the property, for example, because we have had a client queried on it before.
Yeah. Okay.
Yeah. Yeah. So we had to actually supply electricity statements and things to show that they genuinely moved into the property.
Yeah.
Yep.
What if I inherit a property?
Yeah, so that depends on when the deceased acquired the property. So if they bought it pre-capital gains tax, September 85, and you sell it within 2 years of inheriting it, there's no capital gains tax at all. But if they bought it post-CGT, then your cost base becomes whatever their cost base was at the date of their death. So we always get clients to have a chat with us about that because it can be quite confusing for clients as to what to do, so, and just to give them some advice on like what the potential capital gains could be if they don't sell it within, if it's pre-CGT and they don't sell it within that 2-year time frame, for example.
What if I renovate before selling?
So usually the renovation costs, they would be not classified as a repair, as some clients might hope to, claim. So they would be capital costs. They would add to the cost base of the property. So if you paid $700,000 for a property, you did $100,000 worth of renos, then your new cost becomes $800,000, and it reduces any capital gain essentially.
What if I Airbnb my split?
It's pretty much the same as just renting it out. So, you rent, the income still needs to be declared, the expenses. It can be interesting if it's your main residence, like if you're Airbnb out part of your main residence as well, that can be a little bit tricky. You might put your CGT exemption at risk. But yeah, if you Airbnb, then you just declare the income and claim the expenses accordingly.
What if my kids move into this?
If the kids move in, then it doesn't change your tax obligations at all. You still need to, there's no main residence exemption or anything like that just because your daughter's moved in there.
What if she's got there's to be a market rent?
Technically, yeah, it does. If you're charging below market rent, the ATO can look at it because they can say, well, then your deductions may not be deductible.
What if I buy a property with siblings?
Yeah, so you need to be a little bit careful sometimes with that because obviously everyone has different objectives. It's like in a super fund, the parents and the children in a super fund together, the parents are going to retire earlier and they might have different investment objectives to the younger kids, for example. So it's like being in business with someone. Sometimes it's a good idea to have like some kind of agreement in place because somebody might want to sell first, for example. Like your circumstances might change and you say, hey, I need actually to get my equity out of the property. So because I'm going to do X, Y, Z. And I'm like, well, I don't want to sell. So you kind of need to have things in place there between maybe an agreement between each of you as to know what to do in the event of co-ownership. So, but it doesn't change anything in terms of everyone declares their portion of the rent and the deductions associated. Yep.
It's a bit.
It just makes it it can be a little bit messier. Yeah.
From my side, I often see people making property decisions first and speaking to their accountant. Do you agree that getting advice early can completely change the financial outcome?
Yeah, look, it's always good to run it past an accountant or your tax agent just to say, this is what I'm thinking of doing. Is this the right structure? They might have children that might potentially be going through a divorce or something, so they might be looking for asset protection kind of issues. So, yeah, it's always worth just running it by the accountant or tax advisor. They might not know about a tax depreciation schedule.
Yeah.
So it's, always a good idea.
So I suppose they're kind of the core things that if somebody came off the street, came and saw you, kind of would just say to everybody as a first kind of conversation.
Yep.
Yeah, there are some core things. It's really...
Yeah. Yep, that's right. And just understand what it is that you're actually getting into. Like, you know that if you sell the property, there's going to be potentially capital gains tax to pay at the end. So, because a lot of people just go, well, I just pay off the debt and I've got the extra cash available to do whatever I want. So, no, the ATO has to take their share, So it's just a bit of education, really, client education. Yeah. So, yeah.
I think what today's conversation really highlights is that property ownership is about far more than simply buying an asset. The structure, planning, tax implications, cash flow management, and long-term strategy around the property can have a huge impact over time. Sometimes the biggest mistakes happen when people make decisions without fully understanding the financial side of things. We've also put together a simple property investor end of financial year and tax checklist to help property owners better understand what they should be reviewing before the end of financial year. We'll include this in the link in the show notes. Christie, really appreciate you helping break down some very complex topics in a way people can actually understand. Thanks for listening to the Melbourne Property Brief, and don't forget to subscribe so you don't miss the next episode.